Hey everyone, Mortgage Nerd here, starting a new campaign. It's to make rates low again. Yeah, no, I'm not getting political here, just having fun with this and maybe getting some attention. But all right, what we're talking about though is about rates going down and how rates will be low again. I predict they're going to drop about 2% in the next 2 years from where we are right now. Right now we're in the high sixes still, depending on where you are with credit and down payment and all this stuff. So let's look at the history of rates. So we're looking at my screen, you go back to 2019, this is the 10-year treasury. We were pretty low, we were under 2% on the 10-year, dropped all the way below 1% during COVID, and then started to really rise up above 3% for the 10-year in 2023, and then hit all the way up to 5% on the 10-year in 2023 before dropping fast October to December, all the way below 4, and then went up and came back down below 4 is where we are now. So let's zoom in a little bit. 2022, you can see all of that again. This rise here earlier this year, even though people expected rates to continue dropping this way, by the way, rates follow the 10-year treasury. There's a gap between them. So whatever the rate is on the 10-year, mortgage rates are X amount higher, anywhere from 1.5% to 3% higher than this. So if right now we're just below 4%, if you add 2, we should be in the high 5s for rate. But no, you got to add 3 because right now there's a very big gap. That's what we're going to get into on this video. So now a little closer on the 10-year, you see the last 3 months, we kept hitting this low point. I drew this line in here to show the resistance that it created. And then the Fed meeting talking about their rate coming down in September, and then unemployment going up higher than expected dropped us below. And then we had to come up and test the level again. We tested it and it came off. And so we're in a healthy under part of this resistance level. It's really crazy that I drew this line in the short term. And then look what happened going back to the long term. The highest point that we had, the 5%, came up against this same level. That's pretty interesting. That's technical analysis for you. Now, we're going to get away from the 10-year treasury. We're going to go to mortgage rates only. This is the average of the 30-year fixed rate in the United States at all these points in time, going back to about 2010. You could see every time we got over 5% slightly or touched it, we came back down for that whole decade, the 2010 to 2020 decade. Rates were always in the 3s and 4s. People say, oh, we'll never see rates go that low again. No, I don't think we'll ever see those 2s again. But to dip into the 3s and be in the 4s, it is very, very possible. And I'm going to show you why. Aside from this chart where we're in this healthy market all this time, then COVID came and we dropped this way. And then now we came above that 5% because we needed the high rates to slow inflation. All right, so this is the gap between the 10-year and the mortgage rate. 10-year is the one I showed you first, under 1% during COVID, 5% at the high, right now around 3.8, 3.9. This is the gap between that and where mortgage rates actually are. So if we're around 3.8 right now, 2% over is 5.8 in mortgages, 3% over is 6.8 in mortgages. And I'm repeating myself, but I want to make sure you get this. So the gap here, you can see we were at 1.5 a lot of the time, 1.6, 1.8, that gap, all the way to COVID. And COVID kind of messed it up. We were in this nice little range, and then COVID, boom, brought that gap real high, real fast. And then it came down real fast. That gap closed fast. Look how fast it closes. I want you to pay attention to that. It went up, it might stay up, but then the gap can close very quickly depending on what's going on in the economy. So we were all the way down to a little over 1 in that gap for a little while there. That's when those rates were really low. And then we've been up to the gap being at 3%. So now it's not a full 3%, it's around 2.6, the gap between our rates and the 10-year treasury. But what happens when that gap gets back down to 1.6? If we're at 2.6 right now, so that's an entire 1% drop in interest rates and mortgage rates. It's important to know the difference between mortgage rate and the Fed rate. If the mortgage rates drop an entire 1% just because of the gap, not including because rates are naturally going to go down, that's important to understand. This is why we're going to make rates low again. I can guarantee you that. Ask anybody. All right, so this shows the gap again. The darker one is the 30-year fixed and the 10-year treasury is under it. So this was in 2000 around the dot-com bubble. This is around 2008 when the market crashed. Now look at this gap. It's the largest gap that we've ever seen between the 10-year and the mortgage rates, and that's now. It's another chart showing similar. The mortgage rates are higher than on this gap and lower throughout history. So we're going to close that gap. Mortgage rates are going to come down about 1% naturally. We're going to see another 1% drop in the gap. So we're going to see at least 2% drop in interest rates over the next year or two. That's my prediction. I hope you enjoyed this. Mortgage Nerd out.